Hello and welcome to this Hamptons webinar, Has the Door Closed on Buy-to-Let? I'm Anne Ashworth, property and finance journalist, and in the course of the next hour, we're aiming to give you all the facts and figures about the lettings market now at this time of great change and extra focus on landlords' responsibilities. Among the questions that we'll be trying to answer is it worth staying in the buy-to-let business? Is this the moment to get in? And I have to say that I'm really delighted to say that I'm joined by Anisha Beveridge, Head of Research at Hamptons. You see all their lovely smiling faces on screen now. Adam Fairweather, Regional Director at Hamptons, and Ying Tang of Dynamo, the mortgage broker. As you can see, we're going to be covering all your bases. Now, there's a chat box for all your questions, but we've already had so many that we've actually rearranged the running order of this event today to answer as many as possible. And those that we can't answer, the team will try to address later. Now, we've only got an hour. There's a load of ground to cover. So let me go over without further delay to Anisha Beveridge, Head of Residential Research at Hamptons, who's going to run you through what's happening now in buy-to-let. Anisha, over to you.
Thank you, Anne. Well, I think let's take a step back a couple of years to begin with, really. And what you can see from this chart here is that over the last 20 years, the private rented sector in England has doubled in size. And last year, there were nearly 4.4 million privately rented homes in England. And it's actually been one of the fastest growing housing sectors in the country for 14 out of the last 20 years, which is quite remarkable. Most of this growth came in the early 2000s and mid 2000s when house prices were rising quite quickly. And there was also a more generous tax and lending environment, which we'll talk a little bit about later today. But sort of from that 2015 time, unfortunately, that started to change. So in the spring budget that year, George Osborne announced that the amount of tax relief that landlords could claim on their mortgage interest would be reduced from the 100% mark to 20% so that it was in line with the basic rate of income tax. And then actually following that, sort of in their drive to boost home ownership, I think, in the autumn budget, it was also announced that their second homeowners would have to pay a 3% stamp duty surcharge on any new purchases. So these policies not only really reduced the profitability for those who already owned a mortgage buy-to-let property, but they also increased the cost for those hoping to buy a buy-to-let in the future. And unfortunately, they weren't the only things. So over the last few years alone, we've seen the removal of a wear and tear allowance, tighter lending criteria, more regulatory checks in the form of EPC standards and electrical certificates and things like that. As well as proposals to end no-fault evictions. And for some landlords, particularly who were higher rate taxpayers and those with bigger mortgages, these changes just meant that their buy-to-let was no longer profitable and caused some landlords to sell up and leave the sector. So as you can see from the chart here, since around 2016 time, the proportion of homes sold by landlords has actually outweighed the proportion of homes bought by landlords. And as a result, this caused the sector to shrink. So last year, there were around 250,000 fewer privately rented homes in England than there were at the sector's peak in 2017. But this next slide here shows you that despite these challenges, landlords have actually found new ways to adapt. And one of the biggest changes we've seen is this shift in the way that landlords own their property, with an increasing number of landlords putting their buy-to-lets into a limited company rather than holding them in their own name. And this is generally because there are tax benefits in doing so, although it doesn't work for everyone. One of the biggest benefits is that in a limited company, you can still offset your costs before you get taxed. And that includes your mortgage interest too. And the other benefit is that you pay corporation tax on your profit rather than income tax, which at the moment stands at 40% for a higher rate taxpayer compared to 19% for a company buy-to-let. So there's quite a big difference there. But you do sometimes face further tax when you take cash out of the company once you exceed that annual dividend allowance, which is something to bear in mind too. So perhaps unsurprisingly, more companies have actually been set up to hold buy-to-let properties between the beginning of 2016 and the end of 2020 than in the preceding 50 years combined, which is really quite remarkable. And by the end of last month, there were nearly 240,000 buy-to-let companies up and running, which you can see from the coral line on the chart on the top right-hand side here. It seems that this shift has continued early into this year too, and doesn't really show too many signs of stopping at the moment. I suspect the stamp duty holiday has actually boosted these numbers a little bit further. So the maximum £15,000 saving that landlords can make by buying during the holiday has actually encouraged more landlords to buy over the last few months. And last month, there were nearly twice as many homes bought by landlords than there were during the same time last year. But it has also made it cheaper for individuals to move an existing buy-to-let property into a limited company, because you have to pay stamp duty tax on the transfer. So there might be an element of that being shown in the numbers too. But one of the other changes we've noticed in the sector is a shift away from fewer accidental and smaller landlords towards bigger full-time landlords who are probably more likely to own multiple buy-to-lets and probably more likely to own them in a limited company too, because of some of those benefits. But we actually think that the stamp duty, combined with the fact that there are just appallingly low interest rates available on cash sat in the bank at the moment, and we think that's actually encouraged a few sort of first-time and smaller landlords back into the buy-to-let market, many of whom are using a mortgage to fund that purchase. But another big change that we've seen over the last few years is a focus on yield. Now, yield is a common term used in the buy-to-let world, and it looks at how much rental income a landlord receives relative to the property's value. And generally speaking, when people are talking about yields, they're talking about gross yield, so before any tax and costs are taken into account. But one of the reasons for this sort of focus on yield is because the tapering of mortgage interest tax relief has actually caused lenders to apply more stringent affordability tests, particularly on higher rate taxpayers, just to make sure that the income landlords receive more than covers the mortgage. And I'm sure Ying will talk a little bit about that later. But it has actually made securing high loan-to-value finance on lower yielding properties a little bit trickier over the last couple of years. But this sort of quest for higher yields that we've seen from landlords has pushed them into buying properties further away from where they live. And many landlords have been heading north to buy their first buy-to-let or expand their portfolios. The landlords are now buying buy-to-lets nearly 40% further away from where they live. And while the average landlord still only invests around 6 miles away from their home, London investors are buying nearly 40 miles away in order to achieve the best return on their investment. So without doubt, I think the rental sector has faced a range of challenges over the last 5 years, shall we say, and probably no more so during this last year of the pandemic. But I think despite the challenges, landlords have adapted quite well and are continuing to scope out new opportunities, which is ultimately changing the makeup of the sector. And I think these changes are probably here to stay for the long term too.
Anisha, thank you for that very interesting insight into the greater professionalisation of buy-to-let. Now, what is your sense of the government's stance on buy-to-let now? Do we think that their stance has softened, or can we expect further tax moves that would restrict enthusiasm to invest in the sector?
Well, I think that's probably the million-dollar question, isn't it? But I mean, we know that the majority of it started back in 2015 with George Osborne, who isn't the most popular guy when it comes to landlords, unfortunately. But the government are clearly on a path to try and boost home ownership. And the theory has been over the last sort of decade or so that actually it's landlords who have stood in their way. We saw in the budget a couple of weeks ago that Rishi Sunak announced some new support for first-time buyers through the mortgage guarantee scheme. And that's there to really help buyers with smaller deposits. So to kind of answer your question, I think really it depends on how well their home ownership targets are met, probably more than anything. I think they'll certainly keep an eye on the buy-to-let market, but for me, it seems almost as though that the barriers have been sort of hiked enough to prevent lots of landlords kind of buying into the sector. But yet they've been lowered enough to help first-time buyers get onto the housing ladder, which sort of reduces competition between those two, which I think was the ultimate goal, even though they possibly don't compete quite as much as some people think. So, no, I'm not sure there's much more to come, but you never really know.
So what are you expecting on tax day, this day in which the government is going to unveil its thinking on capital gains tax, inheritance tax, and the general tax scene that we can expect to unfold over the next few years?
Yeah, I think it's the 23rd of March, isn't it, when the Treasury are releasing some sort of consultations to try and decide what they want to do with the tax environment over the next couple of years. And one of the things they're looking at, as you mentioned, is capital gains tax. And there were some rumoured changes before the budget, so we were sort of listening very closely to see whether they came through, and they weren't. But apparently the proposals are to increase capital gains tax and bring it in line with income tax rates. And from a landlord perspective, this would particularly affect landlords who have accrued bigger gains through historical house price growth. But like all of these things, you have to have made a gain to be taxed in the first place. So it won't affect everyone. And some people's gain will still be covered by their personal allowance. But we did run some sums on this a couple of weeks ago in the lead up to the budget. And for the average higher rate tax paying landlord who made around a £70,000 gain last year, increasing that capital gains tax rate from 28% to 40% would probably mean that their tax bill would rise from around £16,000 to around £23,000. And it's far more likely to impact landlords in London and the South, where house prices have risen that little bit more. So it's quite a controversial policy, to say the very least, and it would be quite a big adjustment actually. So I think we'll have to wait and see what comes out on that one.
Anisha, thank you for that. Now, I'm now going to bring in Adam Fairweather of Hamptons to give us a feel of what's happening on the ground. How the average landlord is feeling in what has been an extraordinarily challenging year, given the pandemic and given the government's moves to try and keep people in their homes. Adam, what's it like out there?
Hi, Anne, and good afternoon, everyone. I think that's a really interesting question, and it's been an amazing experience to see how both the market has responded and also the clients we're lucky enough to work with. I think it would be churlish to ignore the fact that there's been a degree of anxiety out there. But I think what the last year has taught us is actually the market is resilient, the market is adaptable, it's really agile, and things have changed. And I think probably the most impressive thing is, for me working at the very front of it, is how the landlords and tenants have worked pretty seamlessly together to get some really good outcomes. I mean, landlords play an absolutely vital role in housing our nation. They're doing a brilliant job on the most part, and we should thank them. But particularly in the last year, when things have been quite so difficult, there have been quite so many bombastic headlines around how people are feeling and how people are faring. I think it's been really heartening to see that hopefully now we're coming towards a position where we can see this light at the end of the tunnel. We're in a place of more surety. But on the whole, landlords have been used to working with certain headwinds, be that market-based or legislatively based. But in the last year, we've absolutely seen them respond fabulously well. And I expect the coming days to only heighten that sort of positive response.
Now, one thing you often hear from people who are landlords is they try to do their job very well. And I know many have tried to do that through the pandemic when tenants were struggling, but they feel that there's not enough clampdown on the rogues in the sector. Is that what you hear from your clients?
I think the by far and away the majority of the landlords in the market are well-to-do, well-respected, working hard and doing the right thing. And I think they vastly are under-recognised for that huge and monumental effort that they continue to make on a daily basis. At Hamptons, we are very fortunate enough, the calibre of the client that we work with and very much mirrors that. I think there are always going to be, in any industry, in any market, going to be people that cut corners and look to do things that are dubious, to say the very least, be that legally or morally. But as a whole, I think landlords are very focused on doing the right thing. They're pragmatic, they're intelligent, they follow the legislation diligently, and it's a great pleasure to help them achieve that. And the majority of them doing a good job are the ones that achieve the best results.
That's heartening to know that if you do the job properly and comply with all the laws, you're providing a better service. Now, just very briefly, among your clients, do you sense an enthusiasm to add to their portfolios, or are they just waiting and watching to see what could next unfold in legislation?
Very much the former. I think there's always going to be an eye on what the legislative landscape looks like. But landlords, as I've said several times, are a resilient bunch, and they're intelligent and they're very savvy, and they're continually looking at ways of improving their asset performance, improving their portfolio. But the appetite at the moment, I think, looking exactly as Anisha's described, looking for better yields, is certainly looking now like they're looking at wider geographical areas, and they're very much finding fertile soil in which to invest.
Well, thank you to that, Adam. Now, as I said, we're going to be answering a lot of your questions. We've had so many already. Please put any questions into the chat box, and we will try to get to them later if we can't cover them in this session. But what I'm now going to pass to is the second chunk of our event today, which is, do the sums still stack up? Because you need to make those sums work to be successful and to do a good job in buy-to-let. So it's over to Anisha, who will give us more of the facts and figures now.
Thank you, Anne. Well, whilst answering the question of whether the sums still do stack up, I thought it might be useful to talk through actually how to make them stack up, as I'm sure there'll be many people watching today considering whether or not now is the right time to invest in a buy-to-let. And for me, it's probably more important than ever to make sure you're considering an all-encompassing strategy when it comes to buy-to-let. So one of the questions I get asked the most is, well, where should I be buying? Where are the yield hotspots? But for me, it's actually really important to consider the why, the what, and the how to invest. So I thought I would take you through each of these in turn. So starting with the where, I don't think it's much of a surprise really to reveal that in terms of basic gross yields, that it's northern areas that come top of the list, many of which are the cheapest areas in the country. So your Hartlepool, Burnley, Northeast Lincolnshire, all top the list, where gross yields are averaging around the 10% mark, which is considerably above the Great Britain average of around 5.9%. But I think these averages mask what top performing landlords can achieve. And it's still possible to make strong returns in the south, particularly once you factor in capital growth, which I'll talk a little bit about in a minute. So despite London being the lowest yielding region in the country on average, as you can actually see from this yield distribution graph on the right-hand side, 1 in 5 London landlords still manage to achieve yields above 5%, and 37% of southern landlords manage to achieve yields above that mark as well. And what you can see, which I think is really interesting, is that actually the top performing southern landlords still outperform the weaker performing northern landlords. And I suspect a lot of this has come down to sort of knowing your area in detail and really understanding your target tenant, which is really important. There are lots of other considerations too, and for me, one of the most important questions to ask yourself, which also dictates the where you should be buying, is, well, why am I investing? Is it a strong, regular rental income that you're after, where perhaps you choose to spend that money on a monthly basis, perhaps replacing a salary? Or does that not actually matter quite so much to you, and maybe you're interested in taking advantage of annual house price growth to boost your capital gain when you sell up at the end, maybe for your pension pot or inheritance tax purposes as well? Because it's really important to decide what your focus is, because if you're buying with a mortgage, for example, you probably need to consider rental income more in order to make sure that you're meeting those lender requirements. But actually, if you're cash, like half of landlords are, you do have a degree of a little bit more flexibility. But deciding on really what's important to you may actually dictate where is best to buy. And I think this slightly complicated graph makes that point quite nicely, because it shows how landlords across the regions have made their money. So to talk you through it, we have looked at landlords' total returns over a 9-year ownership period. So how much money they've made from rental income, which you can see in the coral box, and how much money they've made from capital growth, which you can see from the grey box. Their total return is the two of these things added together, so their rental income and their capital growth too. So as you can see, London landlords made the biggest absolute and percentage-based total profits. So the average landlord made £209,000 once they sold up after costs and taxes over that average 9-year ownership period. And that equates to a net yield of around 4.5% each year, which is still pretty healthy. But interestingly, around 80% of this London landlord's total return was actually generated from capital growth, and only 20% came from rental income. I mean, London has by far seen house prices rise more than anywhere else in the country over the last 10 years. But if you look a little bit further along that dotted line at the top, you'll see that landlords in the northwest earn the second highest total net yields of around 4.4% each year. But actually, they've made their money in a very different way, with around 57% of their profit coming from rental income. So really what this says is, while yields from rental income alone tend to be further the north you go, total yields, once you factored in historic house price growth, have actually been higher in London. And so depending on why you're investing, perhaps might dictate where you actually want to buy. So looking ahead to the next few years, I think really we expect house prices to rise a little bit more in those northern regions, which will mean a greater proportion of a landlord's return who's buying there today will probably come from capital growth too, which again is something to consider. But the return you can achieve also depends on what you buy, and often it's the buying element that really dictates how successful your investment will be. So it's really important to do your research and make sure that you aren't paying over the odds for an investment property. If you're willing to do some improvement works, that can really help to add value too, which is worth considering. But generally speaking, flats are the property types that tend to offer the best yields, and they offer better yields than houses across most of the country. But it's also worth remembering that they tend to come with additional charges, such as service charges and ground rents too. And as you can see, actually flats offer the highest gross yield in 83% of areas across England, which is quite a large proportion. And since the pandemic, we've seen this sort of shift in demand for property types, with many people looking for more indoor and outdoor space. And as a result of that, we've seen house price growth soften a little bit for flats, whereas rents have remained a little bit more resilient, particularly in London, which is actually making yields look quite appealing in some areas for flats at the moment, which might be worth considering. But also, as you can see from the map here, it's actually terrace properties that yield better in some of the areas in the Midlands and the North, and particularly those that are let to sharers. So generally, as a result, as a sort of rule of thumb in the mainstream market, the smaller you buy, the better yield you're likely to get, because yields actually fall around 0.6% for each extra bedroom that you add. But this is quite location sensitive, which is why it's really important to know your market, as sort of shared properties and HMO properties do tend to sit in a whole other league of their own. So as we've already discussed, gross yields tend to hide many of the additional costs associated with buy-to-let, and particularly the role of taxation, which is arguably more important now than ever. So it's really important to sit down and work out the sums before you commit to buying a buy-to-let property. But how you buy that property can have a significant impact on your profitability too. So here we have a calculation which shows you how much tax the average landlord in Great Britain will pay this year. We know that the average landlord spends around £190,000 on their investment property. So based on the average gross yield, they'll earn around £11,000 in rent each year. We've also assumed that they have a 75% loan to value mortgage, so will pay just under £3,000 in mortgage payments each year. We've also factored in some other costs too. So what this means is next January is always a landlord's, or any business owner's favourite month, I think, is when most landlords sit down to complete their self-assessments. And that will be the first time that 100% of the mortgage interest will not be deductible. But landlords still do get that 20% credit. So what that means really is that a higher rate taxpayer will pay just under £3,500 in tax over this next year. And they'll probably still make a profit of around £3,720, which isn't too bad. So to answer the question about whether the sums still stack up, I think for the average landlord, it's quite clear that yes, they still do. But to sort of put this figure into context, back in the 2017 tax year, when you could still offset 100% of your mortgage interest payment, the average higher rate tax paying landlord would make a profit of £4,300 based on the same sums. So just around £600 more. In terms of yield, you can see on the chart on the right-hand side here that once costs and tax have been factored in, the average gross yield for a landlord in Great Britain of 5.9% turns into a net yield of around 2% after mortgage payments, your maintenance costs, and your taxes too. But with the boost of capital growth, which we discussed a minute ago, this rises back to 4.3%, which for many, this return still considerably outpaces money sat in the bank and some other investment assets. So, for example, we've shown you here a few comparisons. The FTSE 100 fell around 9% last year, arguably in quite exceptional circumstances, which is certainly something to bear in mind. And fixed ISA rates are averaging around 0.5% at the moment, so they are pretty low to say the very least. And I suspect there will also be some people considering buy-to-let or property in general, just as a way to protect their cash from inflation, actually, which we might see pick up a little bit towards the back end of the year. But coming back onto how you own your property, because it can have quite a big impact on your profitability. And this table here shows you why many landlords have turned to corporate ownership. So there are lots of things to consider with this, so it's really important to seek professional advice because it really does come down to your individual circumstances. But generally speaking, limited companies have more expensive setup and running costs, and mortgage rates tend to be higher too. So as you can see from this example, a limited landlord owning the same property, paying a higher interest rate of around 3.5% versus 2.1% for an individual, they'll still turn a profit of around £4,129 each year. And that's just over 10% more than a higher rate taxpayer who owned that same property in their own name would make. And really this benefit comes from the fact that you can offset all of your costs before you get taxed and you pay 19% corporation tax on any profit. So generally, limited company ownership is more beneficial if you own or plan to buy a few buy-to-lets, particularly if that income would push you into the higher rate tax bracket. And if you don't need the monthly income and are happy to just leave it sitting there in a company, you'll certainly be better off because, there are some sort of penalties on how you can withdraw that money each year from the company. And it's also worth considering that actually corporation tax is due to rise, as was announced in the spring budget a couple of weeks ago. Now, only big companies who turn large profits above the £250,000 mark will be taxed at that higher 25% rate. which, to be honest, will probably make up a very, very small majority of landlords. But it is certainly something to consider. The majority of landlords would still be taxed at that 19%, which we've shown in this table here. So I'm conscious there's been quite a lot of information to take in. So just to sort of give you a little bit of a roundup, I think it's fair to say that landlords have seen a lot of challenges over the last 5 to 6 years, and many investors who bought into the buy-to-let market 2 decades ago would struggle to recognise the market that we're operating in today. There's an awful lot more regulation than there was back in the 90s, and that has sort of served to level the playing field between landlords and tenants. But I think landlords face more sort of hoops to jump through. And in all honesty, I think landlords have to work a lot harder for their money, while tenant expectations have never really been higher. All that said, however, the returns from buy-to-let still outstrips many other options, and putting cash in a savings account has never really been so unrewarding. So my biggest tip is to really think about why you're investing and use that as the basis for your ongoing investment strategy. None of us really know what's going to happen to rental and house prices in the future. But I think if you're planning on using that regular rental income, or if you need a mortgage to buy, then it's more important than ever to really scope out properties that yield well. But I also think that the gap between higher and lower returns has never been more bridgeable, because there's certainly more insight and opinion out there than ever before. And I think you can quickly learn from people's mistakes, really, without having to go through the expense of making them yourself. So hopefully that's given you guys a little bit of insight. And I think we're going back over to Anne.
Anisha, thank you for that very full exposition of what you need to know now as a landlord and the amount of homework that you need to do. Now, I'd like to bring in Ying now from Dynamo Finance. Hi, hello.
Hi there, Anne.
What I'd like to know from you is, what is it out there like if you're trying to get a buy-to-let loan? Are lenders generous, or are they imposing loads of conditions? What's the scene looking like at the moment?
Well, if we're talking about at the moment, Anne, I think things have improved drastically since lockdown 1. Clearly, after lockdown 1, there were massive restrictions imposed. People were worried about prices falling, and criteria was tightened, lending was pulled back. But on the whole, certainly as we've gone through the end of last year and into this year, and with the various government initiatives, lenders have definitely become much more keen to lend the money. There's certainly lenders out there wanting to lend the money, and they're jostling for position. And that means that rates are being more competitive than they have been for some time, but also criteria is relaxing. So, more specialist types of properties, which maybe were struggled to get finance in the past. Think of HMOs, houses of multiple occupancies, where there's, 6 separate bedrooms in a house, and limited company rates, which Anisha articulated excellently earlier in the presentation to highlight the potential benefits by owning within a corporate structure. These rates are becoming far more competitive. There is still a differential between personal and corporate interest rates for mortgages, but it is narrowing, and it's still very low. And if you think about the returns, and Anisha again highlighted not just the rental returns, but the capital yields added together, and minus the interest rate, you're still getting a very good margin of 3 or 4%. So if you're borrowing at 2 or 3%, because rates are really that low at the moment, and your net overall yield from capital gains and rental is in your 5s and your 6s and your 7s, then that extra 4 or 5% is money in your pocket. So therefore, it's still a good place to be, buy to let, and certainly gives you better returns compared to other forms of investment at the moment. So I would say in a nutshell, and the mortgage market is very buoyant at the moment. Lenders want to lend, and the rates are very competitive, and lenders are jostling for position.
Now, just before we bring Adam in on this one, what sort of rates are people able to get? Can you give me an example of a typical rate on a 75 or 80% loan to value deal?
Yeah, well, I mean, it's a little bit like risk, risk and return. The higher loan to value you get, once you get up to 75 and 80%, which is definitely the higher loan to values for buy to let, the higher the rate, because, lenders, if they're going to take more risk by taking more debt on that property, they want a higher return. So, the rates for a 5-year fix, for example, and a limited company is around 3.19. But for a personal loan for a 5-year fix, a 5-year fix is very popular at the moment because the amount you can borrow is slightly higher because it doesn't come under some of the stringent stress testing rates. So 5-year fixes are popular because you can generally borrow more, but also popular because it gives you that longest term security, which in the current climate where things are so uncertain, they're very popular. So, rates kind of range from 1.5% to 2% in a personal name to kind of 3.5% in a limited company name for a 5-year fix product, which are probably the most popular products on the market at the moment.
Right, now, we've had an awful lot of questions about mortgages coming in, and I'm going to try and get through to those questions, but I'd quite like to have a quick word again with Adam on this whole issue. Your clients, what is their perception at the moment of buy-to-let as an investment? Do they see it as a safe haven, given the nervousness in the stock market, or do they see it as a more risky investment than it was previously?
Thanks, Anne. I think we deal with a spectrum of clients, and we deal with them in a spectrum of different places during that investment life cycle. So we deal with clients, landlords who've been landlords for a long period of time, who've seen a huge amount of change in the market and in the legal side of things as well. We see people who've been in for 2 or 3 years. So they've been, exactly as Anisha said, probably since 2015, really seen the greatest amount of change in a short period of time. And of course, we're seeing a lot of people coming to the market brand new. I think it's going to be a challenge for anyone that's been just in the market for about 4 or 5 years, really, to not think that the amount of changes that have happened are the de facto norm. But when I talk to a lot of my clients who've been in this business for, in some cases decades, a lot of them are quite calm. That we go through cycles, and it feels quite cyclical of the market changing. We go through periods of more volatility, and we go through periods of uncertainty. And I think it's probably that more drawn out period of time that allows them to be a little bit less anxious about things. It is easy to look on what the landscape was like even a relatively short number of years ago and compare where we are today with that, and get to a point where you think, well, actually it feels less positive. And quite frankly, it may well be. However, what the most important thing is, and Anisha made that point acutely, clearly, and very, very well, is the fact that in comparison to not how property or investing in property used to be in previous years, in comparison to lots of other investments, is incredibly positive. And that is certainly something which is the mainstay, I think, of the conversation I'm having with the majority of clients at the moment.
Adam, thank you for those insights. Now, as I said at the beginning, we've had a huge numbers of questions, and we're going to try and get through some of them in the minutes that we've got left. And the first ones that I'd like to pose are to Anisha. Now, John, we don't know his second name, is asking, has the door closed on buy-to-let? What are the existing market conditions like? So if you could answer that quite briefly, and then we can get on to the rest.
Yeah, well, I hope, John, we've shown you today that for the majority of landlords, I don't think the door has closed, but there are certainly more hurdles to overcome than there were sort of back in the 90s, like Adam was talking about. And to answer your question about existing market conditions, well, actually, the rental market's held up really well over the last year, a lot better than I was expecting it to be perfectly honest. Rents are rising across Great Britain around the 8% mark, pretty much everywhere apart from inner London. But I think the other thing to consider is that the pandemic has sort of created this urban country split for both sales and lettings. demand levels and therefore stock shortages are much, much higher for homes in both the rental market and sales market in suburban and rural countryside locations. But we are starting to see a very, very gradual return to cities, and we expect this to pick up over the next couple of months as and when offices, shops, importantly, obviously, and leisure facilities all start to reopen again.
Anisha, thank you for that. Talking about the returns to cities, one type of tenant that's not being seen in the cities much are the international students and the overseas executives. What used to be massive demand in the corporate rental market, that's gone away. Do you sense that it's set to recover?
Yeah, we actually have a corporate relocation scheme, and apparently most of their clients are expecting sort of those corporate relocations to return to around 80% levels of, or 80% of normal levels in Q3 and Q4 this year. And they have seen a little bit more interest, particularly over the last couple of weeks, as again, I think the vaccine rollout all sounds a little bit more optimistic. And apparently particularly from the tech, finance and pharmaceutical companies, which possibly that latter one won't come as much of a surprise, but interesting to see the types of companies that are still looking at that corporate relocation world. So yeah, I think it's set to recover, but possibly not quite to the levels that we saw in sort of previous years.
And a new kind of clientele, you suggest, different businesses coming to the fore post-Brexit and post-pandemic?
Yeah, quite likely.
Now, Adam, we've got some questions that I've decided that you should answer. And the first one comes from Rhea, who asks, are the days of investing in flats over a houses the way to go now amid this demand for more space and greenery?
For Rhea, I'd say, look, that's a really good question. In a nutshell, not at all. The apartment market is still very strong. I think we must remember the focus at the moment, the conversation is predominantly around things like outward migration. So taking advantage of flexible working, swapping that urban landscape to that rural landscape, and with commuting less of a factor, it's easy to see why. But let's not forget that the current pandemic, the lockdown, and the lack of international travel are still really big factors, and they're still in place. I mean, once these restrictions now they ease, I'd expect really, it may well start in the media, to them focus more on the inward migration. I actually expect that balance to really be more established in the midpoint, and I'd expect with a bit more media coverage on people really aspiring again to that urban living once the facilities of living in a vibrant city reopen. Then I think that sort of position is going to be much more viable. And so, look, the flat market is very vibrant, and I expect it to go on apace.
Thank you for that. Now, Gordon, he's a very hopeful member of our audience, is asking, could the government reverse its decision that it's made on landlord taxation over the last couple of years? Most significantly, the mortgage interest tax relief. This person wants to know whether that could be ridden back on, and also to ask what the outlook looks like on tenant eviction notices. So if you could give us the idea first on the mortgage interest tax relief.
I think I might be having a few technical difficulties, Anne, so it might be worth going to the next question for someone else and coming back to me.
Right, okay, Adam. Ling, hi, how are you doing?
Hi, very good, Anne, thank you.
We've got a question from Gwen. This person wants to get into buy-to-let. We've obviously excited people about the prospect. Essentially, if you could just give us a brief guide as to how you would apply for a buy-to-let loan. Can you apply for several properties at once? And what sort of deposits are lenders looking for?
Sure. Well, a buy-to-let is clearly very different from owning your own house. Think of it effectively as running your own business, and you're buying a property to rent it out, and you hopefully receive rental income for that and capital growth. And that's how buy-to-lets work. You can certainly do it with more than one property. In fact, many landlords like to scale their business and build up a large property portfolio because they see the benefits from do that. But one thing to consider is, from a lender's perspective, once you have 4 or more mortgage properties, you're classed as a portfolio landlord, and therefore the products and criteria that's available to you can be more cumbersome and harder. So that's definitely a consideration. Generally, the minimum deposit you need for a buy-to-let mortgage is 25%. So you can get a 75% loan-to-value mortgage. However, there are 80% mortgages, and therefore you only need a 20% deposit. However, the stress testing that's put in place generally means that it's very difficult to get 80% mortgages, i.e. 20% deposit. So our average loan-to-value is probably about 68 to 69%. Which then gives enough meat on the bone to ensure that that property investment is a good value. And I just want to build on what some of the guys have been saying about property, is that the one beauty of property and why buy-to-let is such a fantastic investment, given the other returns from elsewhere, to me, is that you can control your risk and you can control your investment by adding value. With stocks and shares, with putting money in a bank, you know what you're going to get, and that is fixed. And from stocks and shares, you just don't know what it's going to do. But you can control buy-to-let investment by extending the property, giving a new lick of paint, and indeed getting a new kitchen or a new bathroom. I've gone slightly off topic, but I just wanted to add that value of why buy-to-let is working.
Thank you. Now, Frederick would like to know, welcome back, Adam. I'm just going to quickly ask you, Ling, this question. Frederick would like to know is, do you think that most lenders will only want to lend to landlords who hold through limited companies in future?
No, I think, lenders will keep the options open for sure, both personal and limited company name. Certainly, Frederick, that limited company is becoming far more popular, as Anisha clearly well articulated. The tax is no longer, mortgage interest relief is no longer tax deductible in a personal name, but it is within a corporate structure. That makes it far more attractive. And because of that, the stress testing for financing for corporate ownership is not as stringent, and therefore your loan to values and your borrowing is that much better. However, rates are still more expensive, as I mentioned earlier. You also need an accountant, and the ongoing costs are more expensive. So I think the key thing is there's no one size fits all. It's important and imperative you align yourself to good professional people, and every situation is different. But if you're looking for a broad brush statement, there is more of a pendulum swing towards limited company ownership now, but it's certainly not going to be only limited company ownership.
Ling, thank you for that. Adam, welcome back. Just about as we lost you, I was asking you quite a complex question about mortgage interest relief. One of our audience would like to know whether there's any possibility the government would row back on those reductions to mortgage interest relief that have really changed the whole buy-to-let scene.
Again, relatively succinct answer. I sincerely doubt it. But I think probably one of the most vital considerations, and certainly the key role for Hamptons, is actually how we can assist our customers to maximise their profit given the legislations, rather than to focus overly on will that legislation be repealed. I think a really large proportion of our customer base actually are outright owners of their assets. So they don't have a mortgage. They're in a position where that they couldn't have ever benefited from mortgage interest tax relief. And with good advice through pre-purchase, through the actual purchase, with good advice on where they purchase and the tenant profile they're aiming for, with discussions around improvement and upkeep, exactly as Yin has described, they've been able to get to a final very positive profit position, and they've made that work for them. So I think it stands to reason, therefore, that our mortgage clients, our leverage clients, can also work within the current framework as it is, and they should deliver equally positive results.
And Adam, another question from Gordon. Tenant eviction notices. Can you just tell us what the current situation is and what do you expect to happen next?
Sure. Well, the eviction ban has formed a mainstay of media coverage for the entirety of the pandemic. It has been extended, and currently it stands at a notice period of 6 months. And I think it's in all likelihood it could well be extended further. But I also think it's easy to overstate how much of a challenge that's actually caused the market. A small proportion, actually, of the tenancies which we've seen, which we've dealt with, have actually even required an operation, a legal mandate to get back possession of the property. I mean, the government, the landlords, the courts, they quite rightly take removing somebody from their home very seriously, and it's often a matter of last resort. But what we've seen by vast majority of cases is, even in the small proportion of tenancies where there have been challenges, actually a mediation role and actually an agreement that can be reached between tenants and landlords to end a tenancy has been far more common. So it's been very rare that actually requiring a legally enforced eviction has been a factor for the market. So whilst it's something to keep an eye on, I think it's certainly not something to be overly fascinated with.
So essentially, landlords that have built good relationships with tenants, they stand both sides in good stead when times are tough. Now, we haven't got an awful lot of time left, so I'm going to just ask each of my three panelists one question. And it is the central fact that you need to be aware now of if you're thinking of going into buy-to-let. First of all, Ling, what key thing do you need to know now?
You need to know your market. When you invest in buy-to-let and property, you need to know your market. And the way you get to know your market is to build strong, deep relationships with property professionals from the whole chain, and to do lots of due diligence on your local area and your market to make sure when you view properties, be it on property portals or estate agencies, like Hamptons, then you need to make sure if it's a good value or not, because it's an old cliche in property investing and buy-to-let, but you make money when you buy. And it's so true. If you do your sums, make sure the numbers work. And if you know the market, then at that point, you're much more likely to succeed in property. So my one point would be know your market.
Right. Know your market. Adam, the central key fact you need to know now if you're going into buy-to-let.
Sure. For me, it's come and talk to us. I mean, Hamptons represents a vast network of more than 90 offices filled with experts, all equally happy, equally passionate about talking through the opportunities that purchasing and buy-to-let provide. So certainly come and talk to us, but also do spend some time considering who you want your tenant to be. It's easy when you consider the profile that you are, and actually, if you've rented in your history, think about what appealed to you, and think about the things that you looked for in your rental property, the must-haves, the like-to-haves. But do come and talk to us, because we've got lots of expertise, and we have certainly lots of focus on helping you achieve some really good results.
So what Adam is suggesting, everybody remember that this is a service industry and you need to know your customer.
Absolutely.
Now, finally, Anisha, the key thing you should know now.
I think it's probably really important to remember that you're actually running a business first and foremost. A tenant isn't living in your home, rather a buy-to-let property is a business, and actually your tenant, as Adam kind of talked about, is your single most important customer. So treat it like that, and it's far more lucrative and just generally better for you to have settled, happy tenants where you're probably likely to make a better profit from it in the long term. Because if you have one tenant staying in your property for 5 years, you're likely to make more money than having 5 tenants stay in your property for a year each. It means sort of no void periods, no having to refurbish in between tenancies and the cost of finding someone new. So it's important to think about these things too, I think.
Anisha, thank you for that. Now, we're just about out of time, so what I'm going to do now is thank our panelists for all the great content they've given to you, and that all of that is on the Hamptons site. So thank you, Ling. Thank you, Adam. Thank you, Anisha. As I said, you sent in an awful lot of questions. The team is going to try and deal with those afterwards. All I can say is now, thank you, and thank you for being with us. Good afternoon.